Welcome to the second part of the course on international economics. In this part, we move on from international trade, which we looked at in the first part, to the second part where we deal with questions about the exchange rate, the determination of the exchange rate in the long run, as well as international financial crises, including sovereign debt crises. So in this chapter, we will look specifically at introduction to exchange rates, sometimes referred to as FX for foreign exchange. And we will look at the following three questions. What particular aspects of the FX market do we need to understand? So again, FX sometimes is used as a shorthand for foreign exchange. So FX is sometimes a shorthand. And how does the foreign exchange market operate? And what is the role of arbitrage as well as expectations? So as a preview, arbitrage will have a central role in the following chapters. So foreign exchange relates to one of the most important prices in international finance. It is the price of a country's currency expressed in another country's currency. So the exchange rate is the rate at which two currencies exchange each other. This price of the currency of a country, sometimes called the exchange rate or the FX rate, is very important. It is the most important price in international economics, the single most important price in international economics, and it needs to be understood properly. Now, there's two reasons why the exchange rate is the most important price in international economics. Number one, it is one of, in terms of volume, for example, measured in dollar volume, it is the most important market in international economics and finance. The international FX market is the most active and the largest in the daily turnover or volume by, for example, measured by dollar volume or yen volume. Now, second, the exchange rate is also an important aspect of international economics because not just by volume of trade, that is something we just talked about, but secondly, also because the price of a country's currency abroad has a huge effect on international trade. And this is what we see here in the chapter. So it determines international trade because it influences the price of goods in different currencies. So what does this mean? It means that if I am going to a shop and I buy a good, that good can be expressed typically in your home country's currency. For example, if you are sitting in Shanghai, it will be quoted in renminbi. If you're in New York, it would be quoted in dollars. And the rate at which the currencies are exchanging, that is the exchange rate, will determine how expensive a good is to foreigners if they would like to import it, or vice versa, to foreigners if you would like to export the good. So this is from an aspect of international trade in goods and services. Now, you can have the same argument when you talk about financial goods or assets. So the prices of stocks, bonds, and other investments will also be affected by the exchange rate. The rate of return in which a, for example, investment yields its return will be different when expressed in different currencies. So it will have an impact also on the flow of finance and assets. In the foreign exchange market, trillions of dollars are traded each day, and the implications of this FX market can be, for the reasons I just elaborated, extremely tremendous. So that is a important motivation why we spend considerable time understanding this single price, the exchange rate. So in this chapter, we will look at foreign exchange rate basics. We looked at what is the behavior of this price, the exchange rate, over time and across countries. And then we look at the market in which currencies are being traded. And we look at two key mechanisms: arbitrage and expectations. So we start with the basics to define what is the rate of exchange, E. It is defined as the price of some currency abroad expressed in the terms of a domestic currency. So because it is a relation with two sides, the rate of exchange of one currency for another can be viewed from either the home perspective or the foreign perspective. Equivalently, in the first part of the course, we looked at trade. If I import a good from abroad, it is an export viewed from the foreign country. So the important basic principle that we find in many aspects in economics and finance is that a transaction always has two parties and two sides. For instance, if somebody is selling on the stock market and there's a stock market sell-off, there cannot be a sell-off without a parallel sell-up or somebody who's buying it. So a purchase of a stock means, by virtue of this being a financial transaction, transact, so the act is trans, so it has at least two sides, needs to be kept in mind always. And the same thing goes for exchange rates. So this is an important piece to bear in mind when we look at exchange rates. And practically, the result is, or the implication thereof is, that the exchange rate can be defined in two different but equivalent ways. And these are important to be kept distinct in your mind. So for instance, first, the number of the home currency units that can be exchanged for 1 unit of foreign currency. So you're sitting in your home country and you ask, how much home currency do I need to give, for instance, at the currency exchange at the airport before you go abroad for a holiday into a foreign country? You can ask, what is the price of this foreign currency? And if it is quoted in the sense that you have to give me X home currency for every 1 unit of foreign currency, this is the first way of is the first way of quoting the exchange rate in terms of 1 unit of foreign currency. So the E, the variable, or the, if you like, the X, which is to be filled in, determines the number of home currency units. Okay. Then alternatively, we can flip the numerator and the denominator instead to suggest that how much foreign currency do I get if I give you 1 unit of my home currency. So think about this as E being defined as X amount of foreign currency for 1 unit of home currency. And the first quotation style would be X home currency for 1 unit of foreign currency. So in the first case, home is at the numerator. In the second case, foreign is in the numerator, is on top. So to avoid confusion, we have to define the country which is the home country and which is foreign, and how we quote it. Which style of quotation we will use. The first style of quotation is called a direct quotation. And this is what we will use in the text throughout. The second style is called indirect quotation. Sometimes these are also referred to as American and European styles of quoting, but it is more clear to call the first style direct and the second style indirect. So we will define E, the exchange rate, as the number of home currency units that can be exchanged for 1 unit of foreign currency. So think about this as the home currency being on top, that is in the numerator, and the foreign currency being in the denominator. So what does this imply for the direction of change? So if we define the exchange rate as the number of home currency units that we have to exchange in order to get 1 unit of the foreign currency, you will note that a fall in E is a appreciation of the home currency. Okay, it is an appreciation of the home currency. And it's important to always make sure that we know which currency we are talking about. So the appreciation of the home currency, of the H currency. Since the price of the foreign currency is falling in this situation. So if E is falling, say from 10 to 5, previously, and let's assume we are in the United States and dollar is the currency, and the foreign country, let's say, is South African rand in Africa. If E previously was 10, it means that I have to give up $10 to get 1 rand, one foreign currency. Now E has fallen to 5. I only need to give up $5 to get 1 unit of the foreign currency. So this is an appreciation, a rise in the value. So let me repeat. A fall in E under this direct quotation style of the exchange rate, a fall in E means a rise in the value of the home currency. A rise in the value is called an appreciation. Something that you appreciate means that you hold it in high esteem, high regard, or high value. Similarly, if you have a rise in E, that means under this direct quotation style that home currency, the dollar in this case, depreciates. Depreciation of the home currency. Depreciation. So why is that a depreciation when E rises? That is the case because a depreciation means that when previously it was 10, E was 10, let's say now E is 20. It would suggest that now I have to give up double the amount of dollars, the home currency, in order to get the same amount of foreign currency. So a rise in E means a fall in the value of the home currency, which is called depreciation. Now recall what I just mentioned about in international economics, so inter-nations, that is between two nations, at least two nations, if not more, there's always two sides to the same transaction. There's two parties, one party and the counterparty. So this means that when we are talking about bilateral, that is two country exchange rates, let's say United States and South Africa, and we assume for now we don't look at any other countries, when home currency appreciates, it means the foreign country depreciates. Similarly, if the home currency depreciates, the foreign appreciates. That is why it is important to refer to what is the home country and which currency we are talking about that is appreciating or depreciating. And here in this book, we don't have to specify that we use the direct quotation unless otherwise noted. So that is important to keep in mind, that we use this direct quotation method, which has the home currency on top, that is in the numerator, and at the bottom, that is the denominator, is 1 times the foreign currency unit. And this means that if the whole number in E rises, it is a depreciation. And if it falls, that is, if E falls, it's an appreciation. So, viewed from the United States as the home country, we can have an example, for example, with Japan. The United States exchange rate with Japan is quoted as US dollar per yen. Dollar on top, foreign currency at the bottom. So dollar in the numerator, yen in the denominator. So when this E, the exchange rate, is rising, the dollar is this table depicts the major exchange rates as they might appear in the financial press. And if we want to start with the United States as the home country and take the direct approach to quoting the exchange rate, we can go to column 2 and see that $1.086 have to be given up in order to get €1. Similarly, $1.474 have to be given up in order to obtain a pound. And how many dollars have to be given up to get a dollar? Which would be 1. So this is why these entries are not depicted. So now we have in this table also the indirect quotation. And this indirect quotation is found, for example, here in column 1. So column 1 shows how much you will obtain if you have a dollar in terms of some other currencies. So in this case, dollar is in the denominator and the foreign currency is in the numerator on top, which would suggest that this is the indirect way of defining the exchange rate. This is confirmed by this being called the European terms. I would like to avoid these terms because it is more clear to use direct and indirect. So this is the indirect way that we've seen in the previous slides of quoting the exchange rates. But we will stick to the direct way of defining the exchange rate in this book. So for the direct, we would look at, for instance, starting with this row. So we have seen that when using the direct quotation in this book, we have defined a appreciation as a rise in the value of the currency. So it's sometimes called a rise in the value, an appreciation, or a strengthening of the one country against another country. And vice versa, if the currency buys less of another currency, we say it has experienced a depreciation. Recall again that when we use the direct way of defining the currency, when E falls, this is a appreciation because the price of the foreign currency has fallen. So if the price of the foreign currency has fallen, it means that the domestic currency has become stronger or has appreciated. So again, think about the example. We have X dollars divided by 1 yen. And if X is falling, it means that the price, the dollar price of the foreign currency has fallen, or the price of the foreign currency expressed in the home currency has fallen, which means that you can buy more of it. As a home country based, for example, investor, your purchasing power in terms of the rate of exchange of currencies has improved. And this is called an appreciation. Vice versa for a depreciation. And I let that to be worked out by yourself. It's good exercise to do and follow the steps and the intuition that when there's a rise in E, it is a depreciation because the price of foreign has risen. So in these direct terms, we have the following implication. When the exchange rate E rises, again, note that this is the direct form because we are viewing it from the perspective of the United States, which has dollar as its currency, which is in the numerator, and the foreign currency in the denominator. So when E rises, more dollars need to be used to buy a single euro, which suggests that there is a depreciation, a weakening of the dollar against the euro. Now, when E falls, there's an appreciation of the US dollar against the euro, and of course, vice versa, a depreciation of the euro against the dollar. Now, why do we specify the foreign country and its currency? These are bilateral exchange rates, one country with another country. And later, we will see that there can be also multilateral exchange rates where the rest of the world is not just a single country, but a basket of different countries' currencies. So when we talk about the size in the change of the exchange rate, we can talk about proportional changes first. So when in 2014, the exchange rate dollar euro went from 1.211 to 1.086, E is fallen. And you should already know that when E falls, where dollar is the home country's currency, when E is falling, the price of the foreign currency is falling, which means that the home currency, the dollar, is appreciating. So when we take the absolute difference, we see that there is a fall in $0.125. When we set that in relation to the base at which we started, we take that figure and divide it by the base being time t, 2014, and then we get a percentage change. We previously discussed bilateral exchange rates, and now we move on to discussing multilateral exchange rates. So bilateral exchange rates are the exchange rate, the rate at which currencies from two different countries exchange with one another. Multilateral is more than two countries. And we now assume an example where we have three countries, so a home country and then two foreign countries. Foreign country one has 40% of home trade and foreign country two has 60%. Now, the currencies of home, the currency of home relative to the two other currencies, appreciate and depreciate respectively by 10 and 30%. So what we then do is we take the 60 and 40% of the share and trade and then multiply that with the change in the exchange rate of 10 and 30% respectively, and then we get a effective exchange rate change of 14%. And that is positive, and it is a depreciation. Remember that a rise in E is a depreciation. The price of the foreign currency rises, which means that the value or the strength of the home currency has fallen. And this makes sense because the second country has 60% of trade with the home country, and the depreciation is large and larger than the other absolute change of 10%. And therefore, it should be natural to expect that the second country's exchange rate change will dominate the effective exchange rate change. So to summarize, multilateral exchange rates look at the trading partners of a country and then weigh the bilateral exchange rates between home country and foreign country 1, foreign country 2, 3, 4, 5, etc., and weigh these by the share that bilateral goods and services trade has, the foreign country has with the home country. So, for instance, imagine a situation where you have a more extreme example. You have United States and China, and then Mauritius, a tiny island somewhere in the ocean. And then home trade with the foreign country, the big foreign country, would be, let's say, 99%. And the second foreign country, a tiny, minuscule amount of 1%, which means that the change in the Mauritius United States exchange rate would have hardly any impact on the effective exchange rate. That is the effective value of the US dollar. Why do we mean here to describe it as the effective exchange rate rather than a different adjective? That is because the exchange rate talks about the purchasing power, at least on the one hand, of your domestic currency of other countries produce. For instance, what they produce and then you can import. And that will be determined by how much you actually, as a home country, would like to import from a country. And this yields the multilateral exchange rate. So similarly, when we want to talk about the percentage change in the effective exchange rate, we adjust the total change in the exchange rate by the base. That is the change in E1 divided by E1 and so on for all the N, capital N trading partners of the home country. So here we see a chart of the foreign currency baskets per US dollar. So in blue, you can see along the range of 2001 to 2015 that the nominal effective exchange rate of the Federal Reserve Broad Index of a basket of 26 currencies has exhibited a decline that was partially reversed after 2008. And the fall in the foreign currency basket here is a foreign appreciation and a dollar depreciation. So note that here we are using the indirect quotation if we assume that home is the United States. So generally, from 2002 to 2015, there was a dollar depreciation starting from the index of 100. Now, if we take the red line, this is the nominal effective exchange rate Fed major currency index, that depreciation is much larger. And the basket of 7 currencies in the red line is smaller than the basket of 26 currencies in the blue line. And the reason for this is that the broad basket includes important US trading partners such as China that maintained a relatively fixed or rather managed exchange rate against the dollar up until 2015. Since then, both US authorities as well as the International Monetary Fund, the IMF, has judged the Chinese currency to be no longer disequilibrating or underappreciated, but rather has reached a band or range in which it is in its equilibrium range. So that is an important fact. And once you have the pre 2015 depreciation of the Chinese currency relative to the US dollar, that obviously would push further down the nominal effective exchange rate index. So recall that the exchange rate, and when exchanging currencies, that is a transaction. So if we talk about a currency such as China being underappreciated, that would push the dollar into higher territory, into a dollar appreciation. So that is the reason why the blue line, which includes major trading partners that have a relatively speaking below pre 2015 relatively low value relative to the US dollar, would therefore, on the flip side, mean that the dollar is relatively strong towards these currencies. Okay, that is, if you like, the reason why we spent a lot of time at the beginning to make sure that we know the difference between the direct and the indirect quotation, as here in this picture, it is the indirect quotation that is used. So if you want to compare the change, if one would like to compare the price level or the price of certain goods in different countries, for instance, a tuxedo, a type of suit, then we couldn't just compare the apples, bananas, if you like, in terms of goods being priced in different currencies. We have to compare it when converted and expressed in the same currency. For instance, when we're in London, we have to ask ourselves, what is the price of a tuxedo in different locations? So China, Hong Kong, New York, London. And then we can ask, how much is the cost of this item in, for example, London, if we take the perspective of the UK. Now, the cost of the tuxedo in pounds will change depending on the exchange rate. And the exchange rate is changed in cases 1, 2, 3, 4 columns. And when the exchange rate is such that Hong Kong dollar to pound and US dollar to pound is 15 and 2, then the price expressed in British pound is all the same across all three different locations. Now, when the exchange rate varies from that, then sometimes New York could be very expensive or Hong Kong could be very expensive. And this depends on the exchange rate. So for instance, if we have the case that we move from, for example, Hong Kong dollar doesn't change to pound, but dollar to pound changes from 2.1 to 19, the dollar pound exchange rate has fallen, and fallen means that the dollar has appreciated. So if the dollar has appreciated, it should make the American good more pricey. And we see this. The price rises from 1,905 to 2,105 pounds. So this suggests that a appreciation, so an appreciation will lead to less exports from a country. And a depreciation will lead to a higher number of exports, and vice versa for imports. So this is a nice example to show this relationship. And in green here, if you are unable to decipher my handwriting, I wrote down depreciation, and in blue, an appreciation of the US dollar against the pound. So we have two types of exchange rate regimes, fixed and floating. And the fixed exchange rate regime sometimes is called a peg or pegged exchange rate, because pegging means fixing to something. And this can be fixed within a narrow range or not at all against some base currency or base currencies over a sustained period of time. And this can happen for long periods if the government is trying to manage the exchange rate market in one or both countries. And quite a number of developing and emerging markets have a fixed or, relatively speaking, pegged exchange rate, while many developed markets have a floating or flexible exchange rate, which is defined as fluctuations that are much larger in range. And the government makes no attempt to fix it against any base currency. Naturally, this is a very extreme case, and this is also not true in the limit, as even most developed countries, including the United States and Britain, as well as the Eurozone, they do intervene in the exchange rate market, but typically in emergency situations and not necessarily so much on a regular basis. So here you can see that the exchange rate behavior of developed countries seems to be one of a free float. There's large variations in the exchange rate between the developed countries, US, Canada, Japan, and Britain. The euro and yen and euro and pound also seem to have large fluctuations. And the Danish krone, however, relative to the euro, was fluctuating very narrowly in a band. And this type of fixed regime is called a band fixed exchange rate. These are a few developing countries. And here you can see that by examining the size of the y-axis scale, that these exchange rate fluctuations are extremely large. And this is the fact that the countries have several macroeconomic structures as well as are exposed to international capital flows that make them liable to relatively large exchange rate movements, and the very large exchange rate movements are defined as exchange rate crises. So India, which we saw previously, is somewhere between a fixed rate and a free float, sometimes called a managed float. And some people in the recent few years, after 2015 to 2020, have described China also as a relatively managed float. So it's not a fixed exchange rate any longer. And it is, however, still somewhat managed relative to some developed countries. Colombia, here in the middle, is a crawling peg, and the meaning of this is that it is allowed to steadily appreciate at a relatively constant rate for several years. Then finally, we have Ecuador. Dollarization is its case, where basically it has abandoned its own currency and adopts the currency of another country, such that there is at that point when dollarization is completed, a exchange rate between the Ecuadorian sucre and the dollar, and after the completion thereof, only dollars would be used in that country. And of course, there can be official and unofficial dollarization in a country, where either the country officially adopts another country's currency or it is done in the black market and illicitly and underground. So in the next slide, we will see a classification of FX regimes around the world. And you can see the different types of regime, from fixed to floating. And some other regime that we have not covered so far is called a currency board. That is quite a strong fixed regime, because it has certain rules and written legal and procedural requirements that make this fixed exchange rate harder, that is more durable. It's less liable to be impacted by ad hoc decision making. And currency boards tends to be quite long lasting, whereas fixed exchange rate regimes of the simple type tend to have a half-life that is relatively short, and they do disappear into the books of history, whereas currency boards tend to have more stamina and take, if you like, take a longer time to break. So currency boards are not unbreakable, but they do tend to persist over time. And one example of a currency board would be Hong Kong, China, which has a currency board relative to the US dollar with the Hong Kong dollar. So here you can see that there's a lot of countries that have no separate legal tender of their own, which includes things such as a currency union like the Eurozone, Eastern Caribbean Currency Union, the West African CFA, franc zone, although there have been developments on this recently, on both Western and Central African franc zones, and you can read about this in the news, where you can talk about and you can look up Emmanuel Macron's policy towards Africa and the colonial past that explains why certain countries in Africa should have the franc, which is the French currency, at least a name in their countries. So feel free to post a comment about this particular topic, either here or in the forum. Then you have currency boards, and you have these two special administrative regions of China, Hong Kong, China, and Macau, China, and some other countries. And there's other pegs, fixed exchange rates, and you can see that there's a lot of countries that are, relatively speaking, in their developing phase rather than being fully fledged developed countries. That is not to say that having a fixed exchange rate is a mark of a developing country, but it tends to go together. So here you see the increasingly floating exchange rate regimes, starting with bands, crawling pegs, and crawling bands, and then wide band managed floating and free floating. And you can see, for instance, the United States in there, the UK in there, and a lot of other developed countries. The market for foreign exchange is not an organized exchange. So if you talk about a non-organized exchange, we define this as an OTC, over-the-counter type of market. And as mentioned previously, the size of this market in terms of the daily turnover is quite large. For instance, in 2013, which is quite some time ago, the global FX market traded 5.3 trillion per day. And this may be, if you like, comparable only in that of insurance and credit default swaps in terms of the daily trading volume. The major locations of the FX market is the UK, United States, and Japan. And there's other FX trading centers, including Hong Kong, China, Paris, Singapore, Sydney, Zurich. But other centers are coming on stream. With the advancement of digital technology, this tripolar world of UK, US, and Japan is slowly being eroded by more centers opening up. The simplest FX transaction is one for immediate settlement. That is, the exchange of one currency for another between two parties with the immediate handover of the rights to those currencies. And this is a spot contract on the spot rather than a contract whereby the delivery of the goods takes place at some point in the future. And the resulting transaction, the price at which it takes place, is called the spot exchange rate. So the rate at which on the spot two currencies are exchanged. And most of the types of trade in the FX market are spot trades. So in addition to that, you have derivatives, which are forwards, swaps, futures, and options, and these sometimes are derived and related to the spot contract. And the spot and the forward rates closely track each other. You can see on the right hand side in figure 2.5, the spot rate and the forward rate are quite closely matched. A forward contract is differing from a spot contract in that the delivery of the trade takes place in the future. So the settlement date at which the trade is being settled is in the future. The time from the, if you like, entering of the contract to the time of the completion of the contract at which the currencies are being delivered is called maturity. So the maturity is the time until the end of the contract. And the price being fixed today suggests that this contract carries no risk. So risk, we have to be careful here how we define it. What risk here refers to is the price risk. We are ignoring here counterparty risk for now and many other types of risk. But when we talk about a very simple form of risk, there is no variation in the price once you sign a forward contract, because you have already agreed to the price at which this transaction will take place in the future. Now, a swap contract combines a spot sale of a foreign currency with a forward purchase of the same currency. And this is commonly done and is done repeatedly. And combining these two transactions reduces the transaction costs. So in other words, somebody is selling foreign currency. Let's say somebody sitting in US and selling yen, and then enters at the same time into a agreement that allows that party to buy back, that is, repurchase the same currency at some point in the future for an agreed price. So I have yen, I want to get rid of the yen for some time, for a few days, a few hours, a few months, and then I sign a forward contract to have ensured the price at which I can purchase it back. And instead of having this as two separate transactions, you combine it into one. And the result is a swap contract. So a futures contract is a promise that the two parties holding the contract will deliver currencies to each other at some future date at a certain ex ante pre-specified exchange rate, just like a forward contract. So a futures contract is the same as a forward contract. The only difference is that futures are standardized. They can be traded, if you like, on an organized exchange where you do not need to have a lot of information about the details, the nitty-gritty details, the fine print, the variables that are written down in a forward contract, whereas in a futures contract, these are standardized. So you can put it down in a few columns and rows in a spreadsheet or in the definition of the product. And this allows for quick, standardized trading on an organized futures exchange. Whereas a forward contract is more like a custom-made, tailored contract that is not so easily sellable and therefore doesn't allow for liquidity and turnover, that is buying and selling repeatedly in the market. This is solved by futures contracts, which are a form of standardized forward contracts. Now, an option is providing the opportunity to one party the right to buy a currency in exchange for another at a pre-specified exchange rate at a future date. So an option is the right to buy a call option, a currency in an exchange for a specified exchange rate. And this right does not have to be executed. So you can exercise your call option, which means that you exercise your right, you make use of your right as a call option holder to purchase the exchange rate of the currency that you have entered into your call option contract. And if you do not agree that this is valuable at that time in the future, because you have an exchange rate that you could get in the market that do not require you to make use of your option, your call option, you just let the option expire. The sell opportunity or the right to sell is a put option. You can put that currency down at the pre-specified exchange rate at a future date. And this put option provides you with a right to sell, but you do not need to make use of that right. So in markets, we would like to distinguish between risk taking and risk avoidance. And sometimes in the financial press, this is described as speculation versus hedging. And this is a concept that is difficult to come by. So we look at the following example. So a CFO at a US firm expects to receive a payment of €1 million 3 months from now, 90 days from now, for exports to France. The current spot price for the dollar is $1.2 per euro. Now, your company will incur losses on the deal if the euro weakens to less than $1.10 per euro. And then you suggest the firm to buy 1 million worth of euros in call options on dollars at the rate of 1.15 per euro to ensure that the firm's euro receipts will sell for at least this rate. And this will ensure a minimal profit even if the spot rate falls below $1.15. This is hedging. So here, risk hedging is understood to be that by the nature of your activity, your natural course of, if you like, business exposes you to certain risk. Here in this instance, because you are in the export business, you are liable to be affected by the exchange rate. And given a exposure to this risk, how to manage that risk is risk hedging or risk management. These terms are very loosely defined and they're commonly used, but I use them here just to refer to the concept of you have already risk that you are exposed to and you try to manage it in the way that allows you to hedge it and avoid it. Of course, at a cost, because in economics, there's no free lunch. So when you want to reduce your risk, this normally comes at a cost because in this case, the contract that you enter into, a call option, has a counterparty because it's a financial transaction, and you or that other party may be paying something for the exercise of that call option. So it could be favorable to you as a CFO or to the person that is on the other side of the trade. Now, the second example is the market currently pricing 1-year euro futures at $1.30, and you think that the dollar will weaken to $1.43 in the next year. And then you like to make a bet, take a punt, and you buy these futures. And if you're right, then you make a profit. And if not, your investment in futures will be a loss. Now, this here is a form of speculation. Speculation here is a form of risk taking, and by that specifically we mean you do not have direct exposure to the euro dollar exchange rate, very direct exposure. Of course, the exposure is always there. So if you might not be an importer or exporter, but if you're an ordinary household who is living in the United States, you will be affected by the euro dollar exchange rate via various mechanisms and channels, including the price of imports to the United States, stock market developments, monetary policy, and so on. So, but here we are talking about in a very narrow lens, what is the difference between managing an existent exposure to risk relative to, on the other hand, the activity of trying to seek out an increase in risk exposure with the possibility of obtaining a return in consequence. And that second type of activity sometimes is called speculation or risk taking. But these terms are quite hard to distinguish. But in general, in principle, they can be distinguished. So most of the foreign exchange trade is taking place at commercial banks. 3/4 of the total volume of FX trade is done by a set of big international banks. And some corporations also involve themselves in FX trade if they are active in markets abroad. Then, in addition to this, there are also government actors, and the policies by the government that could influence the FX market relate to restriction of trading and certain capital controls, and these will be looked at later in another chapter. So this is the so-called triangular trade, and this highlights the concept of arbitrage, which is extremely essential for international finance. So we have two locations, London and New York, on the left-hand side and the right-hand side. And we have the possibility of there being a profit opportunity by traders moving money across borders and trying to take advantage of so-called arbitrage opportunities. That is, opportunities to make money by taking advantage of differences in the rates of exchange and the different prices in different markets. And arbitrage is the activity via which traders take advantage of existing arbitrage opportunities or profit opportunities. And you can see here along path AB, it should be the case that this direct exchange between New York and the British pound, when exchanging a dollar, should be resulting in the same exchange rate as if you would do the trade indirectly via London using the path ACDB. That is, transferring your dollars to London, then selling dollars for pounds in London, and then transferring the pounds to New York. This is ACDB, instead of just remaining in New York and selling dollar for pounds in New York. So in New York, I can exchange my US currency for the British pound, or I can shift my greenback to the UK, then in the UK sell dollar for pounds, and then I have the pounds, and then I transfer the pounds back to New York. Effectively, the price should be the same, otherwise there would be a price differential which would be allowing traders to make a profit. And this activity that is taking advantage of these price differential is called arbitrage. So it can be either the case that the exchange rate could be higher in one place or lower than another place, which is possibility 1 and 2, or that the two exchange rates resulting from the direct exchange inside New York or via London is equal to one another. So the direct exchange rate is taking place in New York, and the cross rate on the right hand side in the equation below is the exchange rate that is implied, that is implicit in the indirect exchange via moving your dollars to London and then changing it there to pound and then moving the pounds back to the US. And the equality condition is a no arbitrage condition, which suggests that for no arbitrage to be possible, the direct exchange rate and the cross rate need to be equal to one another. Here's another form of arbitrage, and this triangular arbitrage is now between a location in the United States where you have a dollar, and you can change that to euros, and then change the euros into pounds, and that implicit exchange rate between the dollar and pounds should be the same as if you were directly exchanging dollar for pounds. So the starting currency is dollar, the end currency is pounds, and it should, if there's no arbitrage, be irrelevant whether or not you have a direct exchange from starting currency to end currency, or an intermediate step in intermediate currency in the form of euros, for there to be no arbitrage. So this slide is explaining that the majority of the world's currencies trade directly only with a few major currencies. So rather than every single country's currency trading with every single other country's currency, you rather have the major currencies trading only with one or two of the major other currencies. So many countries that do a lot of business in major currencies, such as the US dollar, have the option to engage in a triangular trade at the cross rate. And when this third currency, the US dollar, is used in transactions, although it is not the currency of the, if you like, the party on one side or the other side of the transaction, you can call that currency the vehicle currency. As the vehicle currency name implies, it is just used as a vehicle, as a way for intermediating the trade between two trading partners. This would be, for example, two Latin American and a African company trading, and they might set their price of imports or exports in US dollars rather than in their own home currency. So now we proceed to ask a interesting question, namely, if you would sell euro deposits and buy dollar deposits, and by doing so, whether or not you would make a profit. So the question behind it is about the demand for dollars relative to the demand for euros and the exchange rate between the two currencies being impacted by this consideration, whether or not you would be selling euro deposits and buying dollar deposits to make a profit from arbitraging between the two different locations. And more specifically, a trader in New York, we assume, is caring only about how much profit his investment strategy gives the trader expressed in US dollars. So this means that the trader is purchasing the things that he wants to purchase with his profit from his investment strategy in the United States, where goods are priced in US dollars. And so that means, in other words, the New York trader is caring for US dollar denominated returns. That is the unit of account of his investment profit. So having said that, a dollar deposit, that is a deposit in dollars, has a known return in dollars, in a sense that there is no, if you like, fluctuation risks in the foreign exchange. But when you have your wealth invested in a euro deposit, that is deposit where the denomination of the deposit is the euro currency, which pays a return in euro, later, for instance, a year from now, it is not clear ex ante, meaning before we enter into the trade, what the dollar euro spot exchange rate will be in the future. So you have riskless arbitrage and risky arbitrage that imply two important parity conditions, which we will look at, which are called CIP and UIP. So covered interest parity and uncovered interest parity. And what these kind of parity conditions are suggesting is a equilibrium condition for the market for foreign exchange. So it's worth repeating that. The parity conditions, so conditions defining where certain things in the financial market are at parity, they're equal, are suggesting the equilibrium in the market for foreign exchange. And these two conditions, CIP and UIP, we will look at. So in the following, we ask, when the financial market, the market for foreign exchange, that is for currencies, for let's say dollar and yen and euros, etc., if there's traders that like to make a profit, what needs to obtain in this market for there to be an equilibrium? So we can imagine that if there's a arbitrage opportunity possible, that is a opportunity to make a profit, this would not be an equilibrium because there would be traders that would like to take advantage of this. Now, CIP stands for covered interest parity, and it explains the absence of riskless arbitrage as a equilibrium condition in the market for foreign exchange. So CIP is a condition for the absence of riskless arbitrage. And we can look at it in the following in detail. So contracts to exchange euros for dollars in 1 year's time have an exchange rate F, dollar euro, and this is a forward exchange rate, which we've seen before, explained. So if you invest a dollar and hold it in a dollar deposit, your dollar will be placed with a US-based bank. In the future, you get your principal back, 1, plus an interest rate of I dollar. The US dollar bank deposit will yield a so-called dollar return. Dollar return because the return is denominated in US dollar. Now, second, if you invest in a euro deposit, you first need to convert, you need to change that dollar to euros to put it into a euro denominated deposit. And then you do so using the spot exchange rate, where $1 buys 1 divided by E dollar euros today. And these will be placed in a euro account that earns an interest rate I lower subscript euro. Such in a year's time, you would have your principal, 1, plus IE divided by E dollar euro. So just to repeat, the rate of return from investing abroad is your principal, 1, plus the interest rate abroad, I euro, divided by E dollar euro. And divided by $1 euro is the return from investing in a euro account. So in order to avoid risk, you enter into the forward contract, and the 1 plus I euro divided by E euros you have in 1 year's time from now can then be exchanged for 1 plus I euro multiplied by F divided by E. So the use of the forward contract allows you to know what is the return of investing abroad in euro deposits when you express it in dollars. And what allows you to be aware of the future price of the euro dollar exchange rate at which you change your euros back into dollars after having invested them abroad is done by use of the forward contract. Now, this takes away the risk, and again, the risk here is just the price risk, the change in the exchange rate. We are not talking about any other type of risk, such as counterparty risk and so on. Now, this is called, when these two rates of return are equalized, this is called covered interest parity. What it means is that the interest rate, that is the rate of return on the left-hand side of investing in domestic deposits, that is dollar deposits, is equal at parity to the return from investing abroad. And it is called the covered interest parity because we use the forward contract to remove the future exchange rate fluctuation price risk from this transaction, because all the exchange rate risk on the euro has been removed or covered by the use of the forward contract. And if it is the case that these two are equal, there is no riskless arbitrage that could be made to yield some profit. You can examine this if the left-hand side is larger than the right-hand side, or the right-hand side is larger than the left-hand side. There would be a possibility to make profits. But if the rates of return are equal, then covered interest parity holds. So note, this does not mean that, so CIP does not mean that the interest rate in the United States needs to be the same, the nominal interest rate needs to be the same as the interest rate in the euro area. This is not implied. So this is something to bear in mind. What we do mean by covered interest parity is that the interest rate, the rates of return, expressed in the rates of return, is equal once you express it in the same currency. And the CIP is an equilibrium condition. It says that in the case that CIP holds, there is no arbitrage, riskless arbitrage possible. So CIP, if it holds, assumes that there are traders that like to make a profit and they would be moving around their funds from the United States to other locations, for example, to euros, and then move it back to make a profit. Now, this assumes that there is capital mobility, that capital can be invested abroad and you can, if you like, repatriate it back home. Here we see that the evidence on covered interest parity holds once you have capital mobility. So you can see here on the left-hand side the y-axis denoting the profit implied by deviations from CIP. So if the deviation is positive, it means that CIP does not hold. That means the left-hand side and the right-hand side of the equation on the previous slide is not equal to one another. And you can see that starting from the late 1970s, around 1980 onwards, when both UK capital controls were abolished and German capital controls were abolished, the CIP condition was approached and approximated over time. So once you introduce capital mobility by removing capital control restrictions, covered interest parity, which assumes that there's some arbitrage, that is, some traders that are moving their funds between different locations to take advantage of small profit wedges, will over time lead to upward or downward pressure in the exchange rate as well as the interest rate in two different locations. And this will lead to the absence of riskless arbitrage if capital can move around to take advantage of the existing profit opportunities. Now moving on to uncovered interest parity. So uncovered interest parity is a condition, an equilibrium condition for the financial market, that is the market for foreign exchange, that is describing the situation where there is no risky arbitrage opportunities existent in the market. So it suggests that when you have UIP, so uncovered interest parity, that there's no risk arbitrage possible anymore if UIP holds, if uncovered interest parity holds. So in this case, a trader faces exchange rate risk. The exchange rate might be higher or lower than anticipated, and the trader must make a forecast for the future spot exchange rate. Now, he or she needs to make a forecast for the future spot rate because under risky arbitrage, the trader does not take the forward contract to hedge his exposure, his foreign exchange rate exposure. And the forecast is called the expected exchange rate, which is denoted by a small superscript lowercase e. Now, based on that forecast, the trader expects the 1 plus I euro divided by E euros to be worth in 1 year's time 1 plus I euro times E expected divided by E when converted into dollars. So instead of having F here in the numerator, we now have E expected. And that is yielding a expected dollar return on euro deposits. And if that is the same as the dollar return on dollar deposits, then uncovered interest parity holds. It means that if I'm an investor and I can put my funds into the United States or abroad into Europe, I will be indifferent between moving my funds abroad or leaving them at home if the left-hand side of this equation is equal to the right-hand side. So I have some funds and I can place them with, if you like, dollar deposits, or I place them abroad. But if the expected dollar return is the same, that means UIP on the left-hand side and UIP on the right-hand side is equal, I'm indifferent, and therefore there is no need to engage in arbitrage, in moving capital to or from abroad. So this suggests that the traders, the investors, are happy where they are if they have been invested in the country abroad or at home. They have no economic rationale for moving their assets across borders if the UIP holds, which suggests that the interest, the rate of return, is equal across two locations, and this is a uncovered parity because there is an exposure to the exchange rate risk, which is being forecasted by the trader. Now, while this equation might seem at first sight rather mechanical, it actually has extremely important implications. Now, if you look at this equation again and focus on the interest rate, the I's. So assume that you have a interest rate on dollar deposits that is very low. Let's say, for example, 0.1%. This is the interest rate on dollar deposits. And with quantitative easing and certain other economic developments in the United States, you could assume that this is quite close to the current federal funds rate, which is probably right now in the recent years closer to 1% or 0.5%. Now, abroad, you have an interest rate let's say of 3%, so much higher. So if you are an investor, you have your funds, your, if you like, dry powder, and you can invest either at home in the dollar deposits on the left-hand side or abroad on the right-hand side. So why would you not move your funds abroad when you have the availability of a 3% return relative to the 0.1% return at home? And UIP gives the clue. So if the exchange rate, we can make a further assumption, and make this as simple as possible to reduce it to the basics. So if we assume the exchange rate at T, current T, and this is dollar euro exchange rate. It's not really clear as I draw it, but you understand that this is the same notation as on the equation, is equal to 1. So if this is the case, then what must be the case is on the left-hand side, we have 1 plus 0.1, which is barely over 1. And on the right-hand side, you have 1 plus 3%. So 3% would be expressed as 0.03. In any case, on the right-hand side in the denominator, you have 1, because E is 1 today. And the only thing left in the total equation is E to the power of expected. So here it's just not to the power, rather it looks like to the power, but it is just a superscript. Now, what must be the case is that E needs to take such a value for this UIP equation to be equal that would give a clue to why the left-hand side and the right-hand side are equal to one another. So to repeat, so far with this very simple numerical example, we have the left-hand side being smaller than the right-hand side. If we assume that the exchange rate is expected to stay at 1. So this means that the uncovered interest parity is not true. So what needs to happen is that the exchange rate expected in the future will be less than 1, such that the left-hand side and the right-hand side can be equal. So if you expect the exchange rate to be less than 1, which means that E is falling, you recall that a fall in E, if we add home, and home is the United States, it would be, when there's a fall in E, an appreciation of the US dollar, which also means a depreciation of the euro. What does this mean? Think about it. It means that when you are attracted by the investment opportunity of going abroad and investing in euro deposits, because they look attractive at face value, at first sight, without much further thinking, because you just see the 3% headline. But then, if UIP holds, the expectation in the market of the future exchange rate between dollar and euro is such that there will actually be a fall in E, which is an appreciation of the dollar. And that appreciation of the dollar is a depreciation of the euro. So what happens is you put your funds into euro, and then after a year, you want to take them back, thinking that you're very happy having reaped a 3% return. However, if the expectations or the forecast of the exchange rate were true and accurate, you actually would not be so happy, because the depreciation that materialized, that you expected or the market expected, would mean that the effective amount measured in dollars that you are able to repatriate back home after you have made your investments in euro deposits is not as high to warrant or to justify the arbitrage. The arbitrage being having moved your funds to euro deposits and then repatriated them back home to the United States after your investment has reached its maturity. It looks like a simple equation, but it is extremely powerful in teaching the intuition behind arbitrage, market forces, and equilibrium in general, but in the market for foreign exchange in particular. What you can do is you can take this equation, plug in different numerical numbers, numerical examples, and then see what should happen to either one of the variables that you have not filled out. So far we have left E expected unfilled and seen and examined what happens to it. You can play with the equation by filling the numbers out differently, or filling out E expected and leaving another variable, I dollar, I euro, or E dollar euro, left to be determined after you've filled out all the other numbers. And this will teach you a lot of intuition. And you may do this now or come back to it after you've finished reading the chapter, or later for your own consolidation of the knowledge of this topic. What we can do also now is we take the UIP equation, the uncovered interest parity equation, and rewrite it. And what we would like to do is we would like to rewrite it such that we can plug in the numbers on the right-hand side, that is the expected exchange rate, the interest rate in the euro area, and the dollar interest rate. And this would determine the spot exchange rate. So what the UIP implied spot exchange rate would be or should be if indeed financial markets, or the market for FX, foreign exchange, is defined or described by the assumptions that are predicating the uncovered interest parity condition. So what this means is, if we were to assume that there's traders in the financial markets that are wanting to take advantage of, if you like, arbitrage opportunities, of profit opportunities, the equilibrium would be reached that will imply an exchange rate that is pinned down by the equation, such that the exchange rate on the left-hand side is equal to the expected exchange rate multiplied by the ratio of the interest rate abroad and at home. Now, again, you can play with this formula to sharpen and strengthen your intuition, your mathematical intuition and economic intuition. This is always a good habit. Now, set the interest rate euro and the interest rate dollar equal to one another. Then you see the right-hand side collapses just to the exchange rate that is expected. So the spot exchange rate will then be equal to the expected exchange rate, because this third term has just been equalized to 1 if the interest rate abroad and at home are equal to one another. So this would say that if there is arbitrage, risky arbitrage, that has taken up all the risky arbitrage opportunities, any profit opportunities, and interest rates abroad and at home are equal, then the exchange rate today is just equal to what the market thinks is the, if you like, the forecast of the exchange rate. There are a few attributes that are important to bear in mind. You have liquidity, the rate of return, and the expected rate of return. Now, as to the first, the investor's entire portfolio of assets may include several types of assets, including bonds, stocks, real estate, and so on. And the liquidity is the ease and speed with which such an asset can be sold. So, for instance, a house has a low liquidity because it cannot be readily sold at the price which it can fetch. Whereas a more standardized good has high liquidity because there is a possibly large market for the good that can be easily sold without need for much investigation as to its properties, which is not the case for instance a house, which has a lot of hidden information that first needs to be examined and a buyer needs to be found. Then you have the rate of return, which is the total net increase in wealth resulting from holding the asset for a specific period of time. And then finally, the expected rate of return, which is the forecast of the rate of return. Now, when we come to the evidence on UIP, what we do is we divide UIP by CIP and then obtain 1 equals E expected divided by F. And you can just rewrite this as the expected future exchange rate is equal to the forward rate. So it suggests that the expected future spot rate and the forward rate, they are used in two different forms of arbitrage, risky and riskless, should be exactly the same. So it suggests that the if you like, the forward market, when there is no risky and riskless arbitrage possible, so when basically all the profit opportunities has been exhausted by the market participants, it should mean that the price at which the market participants agree on a forward rate should be equal to the expected future spot rate. So it would mean that when you sign a forward contract, the forward rate should be equal to the generally expected exchange rate in the future. And this would suggest, if you are an investor that is risk neutral, there would be no reason to prefer to avoid risk by using the forward rate versus embracing the risk by awaiting the future spot rate. Because the two, in expectation, if you are risk neutral, will give you the same return. So the expected return of just leaving it to chance and using the forward contract will yield in expectation the same rate of return. So another way to look at it is to define on the left-hand side the forward premium. which is the difference between the ratio of the forward rate divided by E minus 1. So the forward premium you can think of as how the forward rate differ from the actual spot current exchange rate. And this is equal to the expected rate of depreciation. So what this means is that the market's rate of expected depreciation should be equal to the difference between the forward rate and the current spot rate. In other words, if there is a difference between what is the current exchange rate, let's say between US dollar and yen, and the, if you like, forward price of dollar yen or dollar euro, in this case, the difference in the forward price, that is the price that you have to pay in the future relative to now, is the expected rate of depreciation. So in other words, you can back out, you can recover, you can uncover from the financial market price of the forward contract the market's expectation of the future movement of the exchange rate. So although, as I mentioned, the two equations that we have looked at, the covered interest parity and uncovered interest parity, seem to be rather simple, they have a lot of interesting implications. One of which is that we can use the forward premium to get a sense of the expected rate of depreciation in the market. And this has a lot of potential for applications. So if one would like to understand where the market thinks, it does not mean necessarily that the market is correct, but where the market thinks the exchange rate will go, a good place to start is the forward price or futures price in certain other markets. But for now, we focus on the forward price for the exchange rate. So here's some evidence on UIP and CIP. And when they hold, the 12-month forward premium should equal to 12 months expected rate of depreciation. And on the left-hand side, you can see a plot, the expected rate of depreciation, and the right-hand side, that is on the y-axis and the x-axis, the forward premium. And you can see that there is some sort of evidence that suggests that there is empirical support for the joint hypothesis of uncovered interest parity and covered interest parity. So the basic takeaway is that on the one hand, while you might be able to use forward prices to understand the market's expectation of the future movement of the exchange rate, in reality, we have to be very careful what kind of evidence we provide. So if you just look at the black line and the red line, it seems to be that the relationship predicted by CIP and UIP is quite closely matched. But then note that we're talking about the 12-month forward premium in the 12-month expected rate of depreciation. And even at that, the line of fit is not great. It is good, but it is not great. Especially if you notice the size of the scale of the y and the x-axis, where sometimes deviations, which are quite large in percentage terms, could be devastating for somebody who is trading a lot of volume on the foreign exchange market. Now, more important than the scale is the time frame. So typically when we talk about the exchange rate, so what we have done here in this lecture so far is we look at equilibrium conditions for the foreign exchange market. And by this equilibrium, we try to find out what is the price. What should be the price of the exchange rate? And we have CIP and UIP. And what we find is that in general, and this is from many, many studies, that in typically the very short time frame, several months or weeks and days, UIP, uncovered interest parity, is not a useful guide for forecasting the exchange rate. The exchange rate at very high frequencies, high frequency means that on a minute by minute basis, on a daily basis, on a weekly basis, on a monthly basis, uncovered interest parity, as we've explained in the previous slides, where we have this equation on the left-hand side, on the right-hand side, the dollar return and the expected the dollar return on the dollar deposits, and on the right-hand side, the expected dollar return from euro deposits. This, when we rewrite it, we can back out what the, if you like, the exchange rate should be, given the interest rate and given the exchange rate. Given here means we plug in, we are able to take from the data expectations about future exchange rates as well as the interest rate. Now, this, if you like, prediction about where the exchange rate should be in the short run, in the very, very short run, is not a useful guide when relying solely on this very simple uncovered interest parity equilibrium condition. So this is to be borne in mind that in the short run so far, and this is many studies have been confirming this, that in the short run there is not a good model yet available that would allow us to forecast reliably and consistently over long periods of time the exchange rate. Now, this is in the short run, where we talk about several minutes, seconds, weeks, months. And the longer we have a time frame, let's say, for example, we would like to forecast the exchange rate for 5 years or 10 years, this is trying to understand the determinants of the exchange rate in the long run. And for that, economic theory, which we will study, will be more useful. And this is what we will study in the next chapter.